Do you understand how to identify a top or bottom in the market? Do you know why paying attention to election levels are so critical? Do you want to learn what's going on behind the curtains and what the industry side of the market is doing? We will dive into those and more today as we follow the money. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Our goal today is going to be to get you out of the typical trader's journey of following marketers instead of traders and eliminate this valley of despair that so many get caught in. We start out in training, we learn from somebody who says they have the right pattern or the right understanding, and unfortunately, we're at the peak of Mount Stupid. And many of us then spend years going down into the valley of despair, and some never get to the slope of enlightenment and actually get back to the plateau of sustainability. We want to remove this valley of despair from your learning curve. And we will show you how focusing on the flows in the market and the money that's in the market can really be advantageous to not falling victim to all of these constant traps. And today we will also address the questions that we are taught as children and which ones to pay attention to. And those are going to be the who, what, where, when, why, and how. And we will also show you what we focus on in terms of cutting through the noise to get the cleanest picture. Before we dive into all of this, though, let's go back a century to the 1920s and 1930s and learn from Andrew Carnegie and Jesse Livermore about stock campaigns. We learned that when an entity wants to go public, or if it is already public and there is a group that has acquired a large position, they will begin to carry out marketing or a campaign to entice the public to take action. And the way that works is we see the market go sideways for a little bit as a position is built, and then we either go down to induce fear to get everybody to panic out, or we go up to create euphoria and hope and get people to chase. And this has been going on in the market for centuries. And you can go back to the tulip fever in the 1500s. This isn't just stock related, but this is any kind of market, any euphoric environment, what is playing out. The difference is this plays out in the markets, but not when we go shopping for our groceries. If we see something on sale at the grocery store, our first inclination is to buy if it's something we're looking for and we've wanted. But when the stock is going down, we get scared and we are selling if we're long, or if we're not in, we're fearful of taking action. As prices rise and eggs are $5 a carton, everybody's upset. But when stock prices are rising, everybody wants to get in and starts to chase and wants to be a part of the narrative. And we want to cut through that noise so you are not trading on emotions and not trading on advice from somebody running a campaign, but following the flows in the market. And that's going to be the biggest thing that's going to help you cut through the noise. And if you can remove these emotional aspects, you will increase your trading edge, whether you are a swing trader, investor, or a day trader, you will increase your edge drastically. And so let's look back to December 18th and the FOMC meeting and what played out and what people were telling you. So, from a media perspective, you had the majority in financial media and on YouTube saying the bull market was done. And you've had Robert Kiyosaki calling for a move worse than the Great Depression starting in about 10 days from now when NVIDIA reports earnings. During that same time, we gave you the business mechanics behind what was playing out in the markets and why this was more likely going to lead to a new all-time high on the SPX rather than the end of the bull market. If you follow the money, the words don't matter. The emotions won't take hold, and you can see the campaign for what it is. And when these media perspectives are giving you a narrative, that is their job. They must sell advertising, get you to constantly watch, and they're less concerned with your well being and more about how to drive their business, how to drive more viewers, how to drive more advertising campaigns to their either their website or their television channel. And that is their end goal. So it's not your well being. We don't know when Kiyosaki or others tell you to get out of equities, if that is because they want to buy what you're selling at a better price, or if that is truly how they are positioning themselves. You need to follow the money. So we'll be transparent on our end. We don't get any money from advertising. We aren't marketers. We are traders. The only money we would get is if you choose to take our courses, but as an average individual, we have seen many educators that are just marketers. And we have seen friends and family lose their retirements and lose substantial capital during COVID and the uh, global financial crisis during 2008 due to poor financial advice. And we want to be able to prepare and equip people to learn the business and cut through all of these external factors. So, how will we follow the money today and which questions matter? Remember who, what, where, when, why, and how. We will also show you several of our prior calls and links to other videos where we have given this information for free in advance of a day or week. So, the who we're going to focus on is who we will see and which participant we're monitoring or which strategy we monitor that is extended and trading either on credit or has no investment and is flush with cash to deploy, and how we monitor that daily. We'll focus on the what. We will help you understand what is going on and the daily levels that are key. The where. We will focus on the key levels to pay attention to and when we would subscribe to the bull market being over. We will show you the key pieces that will help you see the early signs of a top before we get to the big where. So there's going to be early warning signs, like a traffic light turning yellow before turning red. We're going to lay out what those are, but those change. We will also give out the how. We give our students the how of trading these, and we will show how we've done this in the past. And the why, we're going to leave that to the media and to every other expert that's out there. We understand the why because the market is just a business and we follow the money, but there are plenty of whys that could be the trigger, and they all make sense afterwards, but they don't help you ahead of time. And let's look at some of our past calls, starting with the Fed in December. And this was just a volatility repricing event as the skew and the business models needed to be adjusted. If you'd like to learn about that, click the link to the video on the screen now. We also did the same explanation for the crash everyone was panicking about in December of 2023. And you can watch that video as well if you're interested. This past week, we mentioned on CPI ahead of the data release, and we put this out publicly on YouTube, of why a down move was more probable because there wasn't enough insurance in the market. And again, if there's no insurance ahead of a potential storm, then that storm's damage can be catastrophic. We posted this video ahead of the release because at the end of the day, the data doesn't matter as much as the positioning for our trading purposes. If you must know the why, then you'll miss the more important questions that show you where the money is flowing in the markets. And all that happened on our CPI day was we had a lack of insurance. We broke our line in the sand and we came right down to where market makers we knew were going to buy. Out of all of this sea of red, we had one area that we knew they were going to buy. So they could sell the market down and acquire everything. And this is that campaign. Put out the CPI print. Doesn't matter what the number is. Let the financial media write the narrative and explain what it is. When our model says that size traders are going to build a position here, and we see the breadcrumbs of that starting to take hold, our students went long at 60.23. Some of our students went long at 60.30, and we had a very nice move up to 61.40 this week. And we knew that that was going to be where that would change. If that broke, then we know that that's actually a significant change in the market. But until that happens, the why isn't going to matter. It's the where and the who. Who is here? Our market makers. Where are they? At this level. What are they doing? They're going to buy. And we could see that, and you can look at that video ahead of the data release. It was all laid out clearly, and I hope many of you were able to capitalize on that. We'll also go through some examples as well during this video to give you the most important level to watch for the coming months and possibly years, depending on how long it takes to get back there. But first, let's look at some of the whys that could trigger the market to make a substantial change. And those could be tariffs that could affect monetary policy and inflation. Those could be interest rates on either the 2 year, 5 year, or 10 year. They could be the Ukraine and Russia conflict. And Vance saying this past week that economic or military tools are possible, which creates some uncertainty. It could be the Gaza Strip. It could be the debt ceiling fight coming up in a couple weeks. It could be unemployment with all the government buyouts, as this will affect the flows. It could be PE ratios or the Buffett indicator. There's no end to the potential reason for the end is near call, but unlike Chicken Little and the sky is falling, we'd prefer to leave that to the talking heads and economists. We'll focus on the positioning in the market and see what it tells us. We use our line in the sand as a first line of defense. And if we look back to Tesla in 2023, we had laid out in December ahead of the market open that 248.75 was your line in the sand on Tesla, and 231 quarter was the collapse line. So we could go long Tesla 248.75 and have targets of 258 and 266. And we nailed the low a day for that day. The following day, we followed up with our next plan, and our target of 258 was hit, and we were looking for 266. And then we also laid out that our line in the sand had moved from 231 down to 226. And that would be the area that we would want to begin building a short position. So you have three options when you get here. You can either, if you don't go short, you can either just get out of your long and not lose any more capital. Don't be a bag holder. Don't hold in hope. Don't enter that valley of despair. Just get out. There's no reason to have your money at risk if we break that. Or if, like me, you do prefer to short, when that breaks, then you can either short the individual stock or you can trade options, whichever you prefer. If you shorted the stock, let's take a look at how this played out. And we laid out the plan here. And that morning, we nailed the low of the day, 248.75, giving you the entry. The next day, we got to the first target. Took 2 more days, and we got up to our secondary target of 266. And then by January, we broke our line in the sand, and this is where you want to be positioning short. And you could have made 45% on that drop or a multi-1,000% return if you traded options. On that long side, you could have made 7% on the way up or a multi-100% gain, again, if you trade options. That is going to be up to everybody's own risk profile. We've also done a more recent one where we laid out the roadmap from 388 to 410 to 430, back down to 388, and then if we break 351 as our last line in the sand, but that was reserved for students. We can also review Apple and NVIDIA. And we had laid out in June of 2024 that Apple 198.35 was key. And if we held that, our targets would be 222 and 224. And then we'd look for range expansion after the close of second quarter. And we updated our models accordingly. But that was, again, about a week later. And NVIDIA, we laid out that 90.79 was the key level with a target of 135.89. And Apple, we laid it out here at this yellow. And on August 5th, we came right into our buy zone, and August 6th, and you had 2 days that you could have bought for the move up to 224. And then we actually had our range expansion up to 242. And then most recently on their earnings, we had 248 as the high call, which again is where billions are positioned. And we knew that would be the high before seeing a retracement. And then if we look at what happened on NVIDIA, here was our layout for what to watch for. We had laid out that 107 would be a buy zone, but you had to get over 123 to hold. When we get in, we start getting up and we can't get over 123. You want to be moving your stop up so you're not risking as much. And you want to be out when you're seeing that momentum is getting stopped on these next 2 days. So then you just wait for your next buy at 90.79, which that low that day was 90.71. So we missed the low, calling it 6 weeks prior by 8 cents by following these positionings, by following these flows. So we know the key levels, the where, we know the who that's in the market there. We don't know the when always. We know what we'll watch for. So when we do get down there, that's where we want to take action. But we're not going to predict if it's going to happen tomorrow or a few weeks from now. We just know what we'll do when something occurs. And as far as the why, it doesn't matter if it was the yen and the first interest rate increase in 17 years and the carry trade unwind, if it's a volatility event, the why doesn't matter. Let that come out afterwards. If you knew to buy here and you don't hesitate, we laid out that 135.89 was the target, and that was almost a 50% gain. And then it did continue all the way up higher to 152. Again, we aren't compensated by any company or individual to promote these. We follow the flows of billions in the market to know where the edge is, and we gave this information out for free. You will see the kind of disclosure on other sites at the very bottom in fine print that they are either compensated by shares or they're already long a position. We prefer to be day traders, and we will lay out what we are looking for next and be transparent. Most of us in our rooms and most of our educators don't hold positions overnight or very long term because we can see the market much more cleanly. And that also gives us the freedom to give out this information without being compensated so you can use it with your own strategy. We're just trying to demystify what seems completely random. And you can also click the link popping up now if you want to see our live trading on NVIDIA earnings, because again, it is all about the money flows and positioning, which gives us a massive edge. Now, before we dive into this next section, let's be very clear. We are not making any political statements, just observations that you can use to capitalize on as well. And with your own hard earned capital, protect it as much as possible. We will have to assess the current environment and previous environment through the lens of our US election and populist regimes. Populism is when the average class feels their needs are not heard by the elites. And when that sentiment is what campaign promises are based on, then the market has an interesting point of view. First and foremost, there's a need to deliver on these campaign promises. So in the first year of a presidency, we will see a lot of fiscal and monetary policy changes and a drive for a large influx of capital to the markets. Because when you've campaigned on something so intently, and populism is the theme, you need to deliver, which requires drastic changes very quickly. And we will look at prior times that this has been the case and how this has played out. And we're going to look at this on the S&P 500 cash index as we come into these elections and look back at prior elections. And this is where our biggest level for the downside is coming from. So when we mention that we don't subscribe to the bull market being over yet, you'll see where and why we are doing that. Now, there could be a short-term correction coming in the market, or as we saw after the Fed in December, that there was a short-term 3.5, 4, 5% drop overall over a course of a month. But that still isn't the 10% correction, and we follow our line in the sand for that. And with that in mind, the biggest factor for downside ties to populism and elections. And we can look back at 1934, 1938, into the 1960s, 1992, 96, 2016, 2020, and 2024, all to see the same pattern. Populism and protectionism policies require large influx in the first year for a regime to make good on their promises to constituents. Did you know anybody that lost capital and sizable capital during the COVID panic and sold at the bottom? Do you know why the market stopped there? We will look at the when of this change so that you can get a good understanding of what is playing out in these markets. So let's go back to 1992. And Bush, during his first term, had campaigned on no new taxes. So then when Clinton comes on the scene and you had Ross Perot in this election, it was a populist theme election of us versus them. And if we look at what happened in November at our election levels, notice we had a big push up in 93 and where we pulled back in 94. And if we get a little more narrow here, you can see November and where we pulled back in 94. We could not break that election level. It's very key that that holds, and that's what's used to push the market up. And then if we look at 96 in our election, notice where we pulled back during the global financial crisis. And again, this continues to play out when these populist themes are key. So in 2016, we have a new administration as Trump came in and he had been a complete outsider. And we had the first year being a big push. But where did the market bottom in COVID? Right back to our election levels from 2016. Made the market made a big move up. We had Volmageddon in 2018, and then again in 2019 we had a large change. Then we made a move up until COVID, right back to our election levels. And let's go one step further and let's look at what happened in 2022. We have our election in 2020 and our bear market low of 2022, right back to that election. But notice the first year we have that big push up to create that space for the next move lower. And again, this would be when the market really is going to fall apart. Until then, that is your key point. And if we look at what has happened now, even more recently, why did the market bottom where it did in January? And again, we laid this out to you that we were not subscribing to the fact that the bull market was done. We laid out why, from a business standpoint, the market was transitioning, but it was just a repricing event, like getting a whole new set of either clothes or products at a retail store for a new season. You have to reprice. So you move out the old product, you bring in something new, you reprice it, you mark it up. That's what's happening. And where do we come down to? Right to our election levels. So move to the head of the class if you were ready for that and you guessed it. And for our students, they knew that this was an area to go long. Not just because we were coming down in the overnight session towards that area, but when we look at the who is here? Our market makers. What are they doing? Well, at this point, at 5807, they have no product left and they're all invested in, they have all cash. This is our line in the sand. And we knew this Friday before this happened. Where to look. And if they only have cash to deploy, they don't have product to sell, then that downside is done. So the first thing we do is we look for this to get into our area, our red box that we know that all the selling is done. And then we'd look for a move back up to the line in the sand and then to the top where we are all full of product and we have to sell. And so we know these areas and we watch them very closely and we see where the market came down within a point of our 5807 half. And then the market rallied and it rallied to new all-time highs on the cash index from there, right from the election levels. So election levels matter and that line in the sand. And when we look at our bottoms and our tops in our market making model, we can identify with very high odds and precision what is likely going to happen in the market. So the media, the commentary, none of it matters. So when we hear that people are calling for the end of the bull market, we will look for certain things to take place and take hold. We will look for first losing our line in the sand. And that changes daily. So if you want to know where that is, it changes intraday as well. If you want to know where that is, watch our daily videos when we put those out. If you want to learn where these are and how to use them, not just in the S&P, but for any other index, including oil and gold, then check out our course offerings because our students get this information where it updates every minute so they can stay very in tune and on top of the markets. But the first sign is going to be losing that line in the sand to even know there's downside possible. For a bear market to take hold, we're going to have to lose these election levels. Otherwise, be cautious of anybody telling you that the end is near and is crying wolf if there's really no wolf around. So let's go back and review all of this through what is happening and what you can do to see a top in the market. Who is in the market? The market makers and commercial side of the market is this is their business. And following their flows and their breadcrumbs will give us a huge edge because I'm not a billionaire. I'm not a trillionaire. I don't have that kind of money to move the markets. But when these entities do, That's who I want to piggyback off of. Now, what? And we just laid this out. Watch the line in the sand first. What are the signs that will tell us that we are either looking more for upside or downside? The election levels and the line in the sand. That's your what. Where? Where is this going to happen? Well, first is going to be, again, at the line in the sand. But since that changes constantly, you've got to stay updated on where that is. As far as the election level, and your last line is 5,700 on the cash index. So on the SPX, and we look at that instead of the futures because the futures are always adjusting for the cash index. The cash index is what matters. That will be the big point. So 5,700 on the cash index. That's your where. Now, there will be a first where, that warning sign, that yellow light, but we have to put that out daily. When? We're not going to make a guess on when, but we'll follow the flows to tell us when it's time. We don't need to be invited to the party and the big down move or the next big up move. We're content making sure that other guests show up and we're in the right place and it's worth our time. I don't need to be the first guest or even the fifth guest. I am happy to know exactly where I want to be in, make sure that there's enough people there to tell me it's going to be a party, and then jump on. Because we already know the who is likely going to show up. I just want to make sure they're there. The what I need to watch for. We know where it's likely going to take place, but we don't know the when. So we know to watch all the others to tell us the when. The how, we've already laid out how this will play out. We'll lose the line in the sand first and then the election level if we're going to get a bear market. Otherwise, we won't be trusting these calls for a crash. And the why, again, leave that for MSNBC, people on YouTube, Fox Business, whoever you want to get your information from. We're not going to concern ourselves with the why. There's a plentitude of potential whys that we've laid out a little bit before. But at the end of it, those whys aren't going to matter. It's going to come down to the capital and the positioning and the flows in the market. So be sure to protect your capital. You and only you will care about your money more than anyone else will. So if this video has helped you, don't forget to like and subscribe so you stay up to date with all of our videos. And if you're interested in learning how to do this for any instrument and how to read the market properly as a business, then check out our website for our upcoming courses. Stay safe trading this week and have a great weekend, everybody.